paying just an extra 1% in investing fees can take away 33% of our total gains across our lifetime when it comes to investing. Investing fees are so important, and in this video we're going to be running through the main investing fees as well as a few more niche ones that we need to be aware of, and importantly how we can actually keep these fees low so we can keep more money in our own pocket, compounding over the long term, and we ultimately end up with more money in the end.
You serious?
Welcome back to another video. I am Ryan and this is Making Money Simple. We have frequent videos here on investing and personal finance, so be sure to subscribe so you don't miss any future videos. Also on all the other social medias, so if you're on them, drop me a follow. I've also got some products available. All the links will be in the description below. But this video is a very important one and it's all about investing fees. Investing fees are one of the few things that are actually in our control when it comes to investing. We probably don't sit on the board of a massive company, so we can't make decisions. We probably don't work for a central bank, so we can't impact monetary policy or interest rates. So when it comes to the average retail investor like me and you, we have very few things we can actually control, but fees is one of them things that we can control, and it's arguably the most important thing to control when it comes to investing, because as I mentioned, the lower fees we pay, the more money we end up with our pockets in the long term.
Write that down, write that down!
So I've got loads of fees that we're going to be running through. Unfortunately, as you can probably imagine, when it comes to investing, there are a ton of fees. I remember a part of Tony Robbins' Money Master the Game, which is a great book, where he actually looked into some different mutual funds and there was 17 different fees that they charge. Of course, there are some great platforms like Vanguard, but ultimately, all of these investment platforms want our money, they want our business, and they do that through extracting fees in sort of any way that they can. So we're going to be running through the fees. I'm going to be giving you a sort of brief overview of what the fee is and then some ideas of how we can actually reduce the fee to keep more money, as I've mentioned already, in our pockets, compounding for us over the long term, so we end up with more money in the future. The first thing I'm going to say about fees before we get into any specifics is, if you are struggling to find out how much you are being charged in fees, that is a massive red flag. We need to know exactly how much we're paying per month or per year in fees, and if you're struggling to find out a platform's fee, if it seems a bit convoluted or a bit dodgy, that is a massive red flag, and I'd recommend looking for a platform that's more transparent. One reason why I love Vanguard is because you can Google Vanguard full costs and charges. There's a PDF that you can find which shows you every single fee that we will pay. So the first fee, and probably the most obvious one, is the platform fee. This is the fee that we need to pay to essentially use the platform and their services. Platforms have sort of two ways of operating, either as a percentage-based fee. So for example, Vanguard is 0.15%, Hargreaves Lansdown is 0.45% per year, or a flat fee for platforms or brokers where they essentially charge a specific pound amount per month or per year. There's also nowadays a lot of zero commission brokers like Free Trade, Stake, Trading 212. If you want to sign up to any of them, there's links in my bio to get some free shares. But these platforms charge a 0% platform fee. Essentially, it means we pay nothing to use the platform. But as we're going to find out soon, of course, these zero commission platforms are still businesses. They still make money, and a lot of money, so they extract fees from us in other ways. Then sort of linked to the platform fee is also an ISA or SIP fee. So some platforms like Free Trade, for example, who charge £3 a month for a stocks and shares ISA, some platforms will also charge a sort of separate ISA or SIP fee, which can be separate from the platform fee. Some platforms have the platform fee, which also includes all of the accounts that they offer, such as an ISA, a stocks and shares ISA, a junior ISA, a SIP, whereas some platforms then charge a separate ISA or SIP fee on top. So once again, you can see already how it can be a bit difficult to work out what fees you're being charged, which is why it's so important that you know exactly what you're paying. There's such a range now of low-cost brokers, you know, Vanguard, Trading 212, Free Trade being some of them, so there's no excuse to be paying too much when it comes to the platform fee, as well as any sort of account fees as well. The second fee we'll end up paying, which will be the case if you're investing into index funds or ETFs, is an ongoing charge or an expense ratio. This is essentially the fee that you pay to invest into that fund. Now, once again, with index funds that were created in the 70s and now ETFs that are more of a recent phenomenon, it is pretty much rock bottom fees when it comes to investing in the stock market. Whether you're investing into the US stock market or a global stock market, the fees are pretty much rock bottom. You can invest into the S&P 500 for a 0.07% per year fee. You can invest into a global index fund for around about a 0.22, 0.23% per year fee. So it's literally rock bottom fees, and there's no excuse to be paying too high fees when it comes to investing into funds. Vanguard, of course, are the company that I use for all of my index funds and ETFs, but iShares are also another great company which are owned by BlackRock, which also offer a load of very, very cheap index funds and ETFs. Ultimately, the main way to bring our fees down here is to simply use low-cost index funds that track a broad market rather than using high-fee active funds, which probably will fail to beat the market over the long term. So if you're like me and a long-term passive investor, they are the main two fees we will incur, the platform fee and the fund fee. But there's a load more fees we can be charged, and I'm gonna run through some more of them now.
But wait! There's more!
The third fee that we could pay is a trade commission fee. So this is essentially a fee that we have to pay if we make a trade. As I mentioned, there are now a lot of zero commission brokers like Free Trade, Trading 212 and Stake, who will not charge you a commission to trade because it's zero commission trading, but a lot of platforms, generally the larger or more old school platforms, will still charge you a fee. So for example, on Vanguard, if you want to buy an ETF live at its price right now this second, then you have to pay a fee. Hargreaves Lansdown themselves also have a sort of structure where, depending on whether you're buying stocks or ETFs, there's different fees that can be incurred. Once again, it's sort of the matter of you need to figure out what you're investing into and then look for the best platform for you that's going to charge you the lowest fee. And as I also mentioned a minute ago, there's also zero commission brokers where we pay no commission to buy and sell stocks or ETFs, which leads me quite nicely onto the fourth fee, which is the regular investing fee. This is once again normally found more in the old school or larger platforms rather than the new zero commission brokers. But if you want to set up a regular investment, then it can cost a set amount. For example, I think Halifax charge a £2 per month fee for a regular investment. So once again, if you want your money to be invested automatically every month, that's just something you need to be aware of to try and understand all the fees that you're paying. Vanguard don't charge a regular investing fee. That's already included in the platform fee that we pay. Getting into some more of the niche ones now, but I'm just trying to make you aware of as many fees as possible in as short a video as possible. Number 5 is a drip fee, or a dividend reinvestment plan fee. Similar to sort of a regular investing fee, a lot of stocks or funds will pay out dividends. If you're using an income fund, all of the dividends are paid out as cash. So there could, and there probably will be then a fee on, once again, some of the larger and older school platforms of actually reinvesting that money to buy more units of the fund. And I know on some platforms you actually have to wait until that dividend builds up to a certain amount until you can then reinvest it back into the fund. The easiest way to negate this fee is to simply, if you are using funds, use accumulation funds. By using accumulation funds, all of our money is automatically reinvested back into the fund, so we buy more units in the fund. The sixth one now, as you can see, you need two hands now already to count all of these fees, is the FX fee. So if we're buying stocks overseas, particularly as UK investors, if we're buying US stocks, we're going to pay an FX fee, and it's likely that the platform we're using will charge some sort of markup on that fee to essentially make a little bit of profit themselves from us buying overseas stocks. Trading 212 recently announced, I think a few months ago, that they're going to start charging some sort of FX fee. I also think Free Trade do, so it's just something to be aware of. If you're buying and selling overseas stocks very frequently, you're going to be incurring a lot of FX fees in the process. Which leads me on now to number 7, which is the bid-ask spread. So this is now one of the main way, if not the main way, how zero commission brokers will actually make their money from us buying and selling investments. The bid-ask spread is essentially the difference between the buy price and the sell price. What you'll notice is if you buy a stock or an ETF on, say, Trading 212, immediately you will be slightly in the red, and that is because the buy price is higher than the sell price. So if you were to buy an investment and sell an investment in the exact same second, you would be slightly down. Of course, a lot of stocks like Apple, a lot of ETFs like VUSA are very liquid, means they're traded a lot, they're traded very often, so the bid-ask spreads are very small. But if you are trading smaller cap stocks or smaller ETFs, these bid-ask spreads can become quite expensive, up to 1% and that is once again another fee, essentially a hidden fee that we are paying by investing into something. Which is once again, you know, if you sort of are combining now investing into overseas stocks, which incurs an FX fee, and obviously, as we now know, we have the bid-ask spread. If you're buying and selling, you know, say overseas stocks quite regularly on a daily basis, you're going to be incurring a whole whack of bid-ask spreads and FX fees. So it's something that is very difficult to track, but it's something we need to be aware of, which is once again why I just prefer the hands-off, passive, automated investment approach to essentially avoid most of these fees that I'm talking about. Number 8 now, and this is now specifically for us UK investors. If we invest into UK stocks, we are going to pay some stamp duty, which is 0.5%. Just another fee that they charge on us for investing into UK stocks, and it's something that we need to be aware of. Now to finish, I thought I'd rattle through a few more fees that are not as important, but we still need to be aware of as they could affect us. The first one being cash drag, which is essentially, this mainly applies to active funds, which are trying to beat the market. That if we invest into them, they will often keep some cash on hand for any potential opportunities, which is completely fair enough, but the fact that cash isn't being invested and it's losing out due to inflation is essentially another sort of hidden fee that we're paying by giving our money to active funds. Another one I've got here is a front end or load fee. Some funds will charge an upfront fee just to put your money into the fund for the first time. If you ask me, that's an absolute joke. Of course, I only use Vanguard index funds and ETFs, mainly global funds and ETFs, and that fee, as well as a lot of other fees I've rattled through already, are not a concern of mine at all, which is why I really do just enjoy the passive investing approach. Another one is a leaving fee. Just like when they can charge you on the way in, they can also charge you on the way out, which once again is also an absolute joke, but it's just something to be aware of. And when you are investing into funds, you need to be looking through the key investor document, or the KID, and seeing all of the fees the fund will charge you. And the final one I was going to finish on is a performance fee. This is now more applied to things such as hedge funds or specialized funds, but some funds do charge a performance fee. If they hit certain thresholds or certain growth, they will then once again take more of your money. I just wanted to make you aware of those extra fees there at the end. There are even more fees than this, but through watching this video, we've essentially gone through all of the main fees, particularly being platform fee, the fund fee, and then any sort of FX fee or bid-ask spread.
That's a lot of damage.
Those are the main ones that us investors are going to encounter. Of course, if you are investing into individual stocks, which I don't really do personally, there are a few more fees which I've gone through. If you are investing into active funds, there are once again a few more fees that I've gone through as well. So this ultimately, to sort of sum this all up, fees are very important, and the lower fees we can pay, the more money we end up in our pocket in the long term. Not just that though, as you can see, working out what fees we are paying can be an absolute minefield. And I want to emphasize, if it is a minefield, if it seems a bit not transparent and a bit convoluted on a certain platform or a certain fund, that's a massive red flag. And it's best just to avoid that platform or fund altogether. And I guess to sort of bring it all together, looking at all these fees, this is what I just love using. Essentially Vanguard, which is a low-cost platform, and they offer low-cost funds. I know pretty much 9 out of 10 of these fees are not going to be any concern to me. The main fees I'm going to be paying are a platform fee and an ongoing charge. But the beauty of it, once again, is if you just Google Vanguard full costs and charges, you can see every single fee that we will pay, which is very transparent, and that's essentially why I use them for my stocks and shares ISA. And if I ever did open a SIP, I would once again probably use them. But yeah, thank you very much for watching this video. I really appreciate it. Hopefully now you are very clued up on investing fees. If I did miss any, or there are any you have questions about, let me know in the comments. If you enjoyed the video, smash the like button, and I'll see you in the next one.